Hello and welcome to Market Domination. I'm Josh Lippin alongside Akiko Fujita, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
It's a start. But what they need is not just new people, but a whole new philosophy and new strategy. That remains to be seen. And until we see that, you can't be too excited about Boeing right now.
Everything's always on the table or off the table. It all depends on the data and the conditions, in my opinion.
We may even have to raise our target again later this year based on this resilience that has really proven to be even stickier than the inflation rate, because the Fed has had considerable success bringing the inflation rate lower.
We've got 1 hour to go now until the market close, and as always, Akiko and I are here to get you up to speed on the market action. Let's take a quick look at the markets right now. As you can see, we're kind of taking a breather here. Of course, maybe no surprise after the kind of rally we saw last week. You can see the Dow got about 0.4%. The tech-heavy Nasdaq is basically flat right now. And the S&P 500 it's called down about 0.1%. Look under the hood of the SPX right now. Just look at the sector action and see how that's going. You can see kind of a mix right now. Energy, utilities, materials there in the green. You can see healthcare and tech, though, are among those sectors in the red. Also, why don't we get a quick look at what the yield on the benchmark 10-year is doing right now in today's trade as well. You can see the yield is up about 4 basis points to 4.25%. We did get some interesting Fed commentary today as well. Chicago Fed President there, Austin Goolsbee, was talking to Yahoo Finance. We're going to have some sound from that interview coming up. Also, Federal Reserve Governor Lisa Cook was speaking too, and that was pretty interesting. She said, in her opinion, the Fed needs to take a more cautious approach here to those rate cuts. So, Kiko, what's the stock you're checking out?
Yeah, Boeing, certainly the big story of the day, getting a boost after CEO Dave Calhoun and other executives announced they will be stepping down. Dave Calhoun stepping down after 4 years at the helm on the back of course, the incident back in January, the 737 MAX 9 plane for Alaskan Airlines, the door panel flying off of that. And you see the executive shakeup there at the top, not just Dave Calhoun stepping down. You've got Chairman Larry Kellner not seeking re-election. Stan Deal, who's the chief of Boeing's commercial airplane division, also leaving immediately. And then you've got Steve Mollenkopf, who, of course, is former CEO of Qualcomm, leading the search for the next CEO. Josh, this just feels like an extension of what has been playing out, not just over the last few months, really, but over the last several years. If you go back to those fatal crashes that happened in 2019, 2018, a lot of questions about quality control around Boeing and who that next leader is going to be to restore confidence.
Yeah.
And quality control issues.
Yeah, and I thought interesting also is kind of the reaction in the shares today too, popping about 1.5% right now, and sort of already, of course, the questions become, well, who next should step into be CEO? What are kind of the qualities you want to see in that CEO, Akiko? Is it going to be an engineer? Is it a number cruncher? Some combination? Is it an insider or an outsider?
Yeah, and let's bring in Pras Subramanian for that more. You know, Pras, really, when you think about the very latest twist that happened with Boeing, which is the executives at airlines essentially calling to meet with the board directly without Dave Calhoun there. I mean, that really is a sign of just how little confidence there was in Dave Calhoun. Mm-hmm. Now you've got this big shakeup. What's next for Boeing?
I mean, it's a pretty remarkable move for the top director, the chairman, CEO, Stan Deal, head of commercial operations, all basically leaving the door. We're talking about potentially elevating Stephanie Pope. She's going to be the new commercial head. I read a note today saying that she might be the potential CEO candidate down the line, but also more concerned about who's there on the bench. There isn't that much of a bench. They want to get a person with aeronautics experience to come on board. And will they have the ability to not only have the resources to actually make moves and have the backing of the board, but also are they going to have the resources to do that, right? This is a big deal. Would you want to step in that position right now if you're an external candidate? It's a really tough place to be. A lot of eyes on you right now. The FAA, the DOJ, a lot of regulatory scrutiny. It is a very tough job to do around to turn this company around because it's kind of over the last 3 years has been a very, very tough thing to watch.
Yeah, and what's interesting, Pras, too, is it's easier to kind of think about let's kind of move some seats around in the boardroom and the C-suite. It's tougher if you think what actually has to happen here is something much deeper and meaningful, like a real shift in just kind of corporate culture and strategy.
Yeah, so Mollenkopf has been there for a few years now, a relatively newer director, whereas Kellner was there for 10 years and was the chair from 2019. So he's been through it all. He's seen a bunch there, and maybe he's one. I think they mentioned that him and Calhoun were talking about maybe it's time for us to go. At least in Calhoun's letter, at least he mentioned.
Although
that.
Steve, Calhoun's staying on until the end of the year,
Right,
so this
right,
isn't
right.
an immediate change. But you have to wonder. It's sort of two tracks, right? On the one hand, it is about restoring the brand. It is also about keeping existing orders and clients at a time when there's a lot of concern about where Boeing is headed in the next several months.
Yeah, you've already seen some defections from airlines going with Airbus offerings because they don't know when the new MAX 10 will come out. That's still seeking certification. That's a big competitor, and I think it's still sort of in the weeds here. So I think that's a big concern. They want to assuage some of these airline partners and say, hey, Calhoun is out the door. He'll still stick around for a little bit as we can do our search, but it is still a uncertain situation there right now, and they really want to get that order backlog kind of secure. Okay,
well, we'll continue to watch the very latest on Boeing. By the way, the worst performer on the Dow. The stock down, more than 25% year to date. Thanks so much for that, Pras. Well, in an exclusive interview this morning with Yahoo Finance, Chicago Fed President Austin Goolsbee said 3 rate cuts this year are in line, those are his words, with his thinking. But he held off on giving a timeline in light of data to come.
I don't ever like tying our hands or signaling that we've made up our minds or that I've made up my mind before the meetings when we're going to get a lot of data between now and whenever that decision has to be made.
Joining us now is Jim Schmigel. He's the SCI Chief Investment Officer. Jim, let me just get your reaction to those comments that we got from Austin Goolsbee. 3 rate cuts in line with what, obviously he doesn't want to tip his hand per se, but is that sort of along your expectation?
It's not along our expectations. It's interesting to see Austin now talking about it this morning because we also had Bostic and another Fed member out seemingly almost walking back a little bit of the dovishness from the press conference. So Austin kind of bringing a little bit of balance to that. Our viewpoint is it would be a stretch to get 3. We do believe the Fed wants to cut here, so that's an important point. So regardless of whether or not we think they should cut 3, we will definitely get some rate cuts this year. It's important to note these are going to be pro-cyclical rate cuts. I mean, we have inflation over 3% core and headline. We're adding over 250,000 jobs per month. GDP still growing at a decent clip. This is going to be interesting, and I don't think it's a done deal either way.
For investors listening, Jim, do you think maybe it's getting a little too caught up exactly the timing of the first cut and whether it's 2 or 3, or is the bigger lesson there that, listen, they want to cut, they want to ease, they're looking for the opportunity?
I think that's exactly right. I mean, the reality is we've already taken 4 cuts off the table this year. Hasn't really affected the market that much. From our perspective, it's not as much as whether or not they go 1 or 2. It's really keep your eye on the 10-year. What does it mean from a yield perspective? Because just because they put a rate cut in there doesn't necessarily mean we see or we don't see term premium come back into the market. We do have a lot of data. They are very data dependent. We have a big release coming out this Friday when the market's closed. If you do see some firming in inflation, to your point, that could take 1 or 2 additional off the table. What does that do to the 4.25 that we're seeing today in the 10-year? Are we going to revisit that 5% level? That's something that the market really needs to be focused on more so than whether or not we're going to get 75 or 25.
Do you think we will revisit that 5 level?
We do. We do think we will. We think that's an underappreciated risk in the market right now. We saw a budget pass over the weekend. These are huge government spending numbers. There is massive amounts of government spending going on. Talk about that as maybe some type of fiscal stimulus still happening in the marketplace. Now we're talking about monetary stimulus happening in the marketplace while things are still going pretty well. That is, in our minds, that's a risk of reacceleration of inflation and something the Fed needs to be aware of.
So just kind of give your outlook and backdrop there, Jim. In the equity market, how do you want to be positioned?
Cautiously, I would say, because the outcome is not set yet. To your point, if we get 3 rate cuts this year, risk assets are going to love that, and we would expect the equity market to continue to move higher from here. If yields begin to percolate back towards that level, we could be into some rough sailing. So our recommendations to the end investor, make sure you're diversified. The Magnificent Seven, maybe not so magnificent, or maybe not so seven anymore, maybe closer to 2 or 3. And broadening that out, looking for some value stocks, some value exposure, even some active management. We're actually bullish. It's talking our book, understood, but we're bullish on active management in 2024 and into 2025. So looking for some broader exposure, recognizing the concentrated nature of the S&P. We're looking for some broader participation either way.
On that second point you made about value stocks and sort of diversifying, what do you like right now?
Financials, we're big believers in right now. Energy, materials, these are areas that we think represent pretty good value for the end investor. We're still in an inverted yield curve. We do expect that to steepen out one way or the other. That's the interesting thing about the yield curve. If the Fed cuts, we should get a steeper curve. If the Fed doesn't cut and then some inflation and term premium comes back, we should get a steeper yield curve. Either of those outcomes are pretty good for banks. So that gives us a tailwind for those stocks and keeps us interested in the financial sector.
I'm just interested, Jim, how many questions you're getting from clients right now about the upcoming election, and what are you telling them?
We're getting tons of questions, and we would assume that's going to become even more exponential as we get towards year end. One thing that we're saying is that in one instance, it almost doesn't matter. So as polarized as we are and as stark differences you can see between President Biden and former President Trump, the one thing that they both agree on is they're going to be spending like drunken sailors regardless of who wins the election. So that's something that we're reminding clients of. There are certain instances, there's a protectionism bent to both parties right now, and there is an absolute focus on continuing spending. There's no addressing entitlement programs. And again, that keeps us, what does that mean for us, and what does that mean for us, what we're saying to investors? Keep your eye on yields, pressure higher.
It might be the one thing they have in common, Jim. Don't touch entitlements.
Don't touch entitlements. Let's not even talk about it. Don't even look at it. I don't even want to bring it up.
Jim, thanks so much for joining us today.
Happy
Appreciate
to be here.
it.
Thank you.
Coming up, we're just getting started here on Market Domination, the latest iteration of our series, Good Buy or Good Buy. We're going to get you investor insight on 2 stocks to help you make the best choices for your portfolio. Plus, Boeing stock getting a boost from a slew of leadership changes, but is it enough to turn around the company's long-term trajectory? We're going to discuss that with an analyst. And Mizuho downgrading a slew of names in the EV space today. We're going to break down that call on the other side of the break. Time now for our call of the day, and we're going to start here with JP Morgan initiating coverage on Supermicro with an overweight rating. That stock jumping on the news in today's trade. Look at that, about 10% pop. So, Akiko, Supermicro does get a new friend on the street. JP Morgan initiates the name with an overweight. Stock is already a complete monster. It's up about 275% this year. But JP Morgan says, you know what, you should still buy it because even at these levels, Akiko, they looked at growing AI server market, and that, they say, justifies this premium valuation. Talking about that AI server market, they see it going from 41 billion in 2023 to more than 280 billion in 2028, and they clearly think Supermicro has some real competitive advantages in that market.
Yeah, you look at the price target at 1150. So what is that? What, more than 15%?
That's a nice pop from here. Yeah.
Upside from where it's already been. To your point, 275% growth year to date, at least on the stock specifically. And you talk about the growth outlook that they see. They see revenue at a 43% annual clip between 2023 and 2027. So we're talking about the next 4 years. That would bring the market share to 10 to 15% as well. We've talked a lot about the stock, by the way, as sort of, you know, maybe, yeah, I mean, that chart says it all, but that's sort of moving in tandem with NVIDIA. And it really is about the AI potential, NVIDIA with the chips, Supermicro with the data servers.
Yeah, investors are just so hungry to play that theme. So, you know, the kind of moves you see in NVIDIA and Broadcom, and certainly this one. They did, by the way, highlight some risks that they say, you know, investors should be aware of. The industry could become increasingly competitive, of course. Enterprises, they say, they might delay investments if initial returns on kind of AI use cases aren't so great. But that's not their base case. They're buyers.
All right, let's move on to another call that we're watching today. Mizuho downgrading multiple EV stocks, Tesla, Rivian, and NIO, all now rated neutral despite expecting long-term gains. Analysts warning demand, increasing inventories, and liquidity issues are creating challenges into the next year. They've sort of highlighted these companies separately, but really there is the overall theme that we've been talking a lot about, which is that yes, EVs adoptions are still growing, but not at the rate where it has been.
Yep.
You look at where they expect it to be. EV growth now expected to be 15% year on year. That's compared to 25% where it was before. So yes, 15% not so bad, but when you compare it at how quickly it's grown, certainly not good news for those companies. And then when you think about what's been playing out in a market like China, the price cut war, obviously we've seen that in the US as well, but that's going to continue to weigh on margins for these companies.
Yeah, and specific on Tesla, they said, listen, Tesla remains the global leader, no doubt, but then they just rattled off this list of worries they have, Akiko: moderating growth, China competition, you mentioned higher inventory. Stock's already been shelled. It's down about 30% this year, but they clearly think not all the bad news is priced in.
Yeah, and you have to wonder, you know, a name like Tesla, I mean, certainly that is the EV player that investors have been going to, but there is increasing competition. At the same time, we have seen more and more challenges with names like Rivian, the upstarts, the other EVs that are, you know, look, they have the cars out there, but they don't have the runway right now. And there's questions about whether, in fact, they can continue to grow with the cash they have on hand.
And by the way, Mizuho does have some names they still like, by the way. They still, you know, maybe they got a kind of lukewarm on a few EV makers. They did say they still like GM. That's a buy. Their target's 48.
But it goes back to the legacy names that are continuing to sort of be in favor of a lot of these analysts when you think about where the short-term trajectory is, at least for EVs.
For sure. All right, moving on here. Let's go to Apple stock, down nearly 11% so far this year as the tech giant faces several headwinds. The European Union dealing the latest blow as it launches a probe into Apple, Meta, and Alphabet under the new Digital Markets Act tech legislation. Evercore ISI Senior Managing Director Amit Daryanani here now with more on the uphill battle for Apple. Amit, it is great to see you on the show. Let's just start right there. You know, Apple now in the crosshairs, regulators on both sides of the Atlantic. We'll start with this news from the EU. They're launching this probe, Amit, into big tech, including Apple. How worried should Apple investors be about that, Amit? What are you telling your clients?
Yeah, Josh, we think both sides of the discussion, right, be that in the US and Europe, at this point seems to have more noise around it and headline risk versus fundamental risk. You know, even if you enable things like side loading, for example, which is what the EU is trying to get to, we don't think it has a material impact to Apple at the end of the day. You know, if you look at the entirety of EU, Apple does about 1.2 billion of services revenues, of App Store revenues, I should say, from the EU. So even under whatever scenarios that goes to a zero, it really does not make a big dent to Apple's. I'd say the EU App Store business is de minimis for it to have a real impact. We'll have to see. I think elements in the U.S. how they play out will be more material, especially how the Google-Apple relationship is going to get worked out, and what the DOJ comes out on that. I think that's financially is going to be a much more relevant headline announcement than anything else. But a lot of the other stuff we think is more headline risk, more noise, versus a fundamental impact to Apple's model.
So let's hone in a bit more on what's been playing out on the U.S. side. I mean, you talked about that partnership with Google. There's obviously concerns about the search side of things, but also as Apple looks to build out their AI capabilities, that partnership that was reported with Gemini. I mean, how do you think this all plays out when they are under the microscope of the DOJ right now? And what does that ultimately mean on the other side?
Yeah. Listen, I think all these companies have been under the microscope for an awfully long time, right? So I think they're going to do what they have to do to ensure the business continues to thrive. I'll take two parts of it, right? Listen, Google pays Apple $16 to $20 billion is a range out there for being the default search engine. About 40% of that business is obviously in the US. So the risk if this thing gets completely struck down is someone like Apple could lose 40% of that $16 billion number. Let's just say it's about $6 billion of revenues, which is high profit margin, could go away, right? Now, there are offsets to that. I would argue Apple will still get some sort of attack from Google. Maybe it's not all the $6 billion, but there'll be some sort of comeback out of it, right? But headline, that's the risk you have. The Google, Apple default search option goes away.
And let me ask you, this stock is under pressure, obviously. I know it's down about 10% so far this year. In part, I think investors are concerned about, Tim Cook's AI strategy. What is that strategy, Amit? I mean, do you think we're going to get some big news out of Apple's big software show in June?
Listen, our expectation is, yes, you'll get some good news around the AI stuff at WWDC. Now, the stock has underperformed, I think, very, very simplistically for the fact that for every dollar that's going into NVIDIA, it's simplistically coming from an Apple. It's not quite that easy, but I think really it's more positioning and Apple not being an AI story, right? What we think Apple is going to talk about is almost a two-step AI narrative, right? What they'll say is, listen, for very GPU-intensive things like video editing, video image creation, you should use something like Google Gemini, essentially, right? So and they'll have that partnership with Google to do that. For a lot of the simpler text-based AI users, if you may, I think what they'll do at WWDC is unlock local inferencing. And what that effectively would mean is you could actually run smaller LLMs, 3 to 6 billion parameter LLMs on your iPhone. It's going to be faster, it's going to be cheaper, it's going to be more secure for you to do that. So we think there's a huge value prop there. And I think that's what Apple is going to talk about. Smaller LLMs on your iPhone, which, by the way, we believe will trigger an iPhone super cycle. And for the more complicated stuff, they'll probably offload it to someone like Google Gemini and have a partnership with them.
Amit, you're clearly still bullish on Apple. You've got an outperform target price here at $220 a share. What do you think is going to be the catalyst to get you there?
At this point, I would say there are two things that you want to see over here in terms of what can reverse the underperformance of Apple. Fundamentally, I think the AI story needs to get flushed out. We expect that will happen between this earnings call and WWDC, right? So in the next 3-4 months, you'll have this narrative, and I think that would help the story out. The second thing I think you do need to see out of this company is, really a better, headline news environment, if you may, right? So I think to the extent these DOJ, EU regulatory headwinds go away, or at least do not get any worse, that would help you out as well. The third thing we think that will happen this April is actually Apple will talk about capital allocation more explicitly. And we think one of the things they'll talk about is, hey, net cash neutral is just an intermediate goal. Our eventual goal is to lever up at 2-3 times net debt to EBITDA and do larger buybacks. I think as that gets flushed out more and more, that could also be an unlock. But I do think the AI story is probably the single biggest thing that can drive outperformance on the stock right now.
One issue you didn't mention there, Amit, I just want to get your thoughts on China, because Cook's China business has been under pressure. And we could talk about the reasons. It's a shaky economy over there. It's competition from Huawei. But do you see that business, Amit, turning around for Apple in kind of the near to intermediate term here?
Yeah, listen, I think if you had to ask them about this, I think the way we would think about the China business is, I think the issues they have are threefold. The single biggest thing they have is a weaker Chinese consumer. I think the weaker macro is having a disproportionately high impact on their business than anything else. I do think the second and third impact is, nationalism, Huawei being a lot more of a dominant player with their 5G enabled phone is a second issue. And the third one is, I actually think companies like Huawei are being extremely aggressive with pricing and bundling in China versus what Apple is doing. So those are the issues that they have. I think the single biggest one, though, is the weaker Chinese consumer, and that will have to take its own course over 6 months, over 9 months, as that macro improves. We think the consumer will come back. But near term, that's actually going to be a headwind that Apple has to contend with over the next 6 months.
Amit, it was great having you on the show today. Thanks so much for joining us.
Thank you.
On the other side of the break, the newest edition of our series, Goodbye or Goodbye. We're going to get investor insight on 2 stocks to help you make the best choices for your portfolio. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal, to help cut through that noise to navigate the best moves to your portfolio. Now, shifts in credit dynamics in the current U.S. geopolitical landscape may call for a different approach to safeguarding your assets right now. So what's the best way to play your asset allocations? Let's bring in Sound Planning Group CEO David Strzelecki. David, let's start out with your buys here. And you like the metals, and specifically what you like, David, gold and silver. Your first reason here, Dave, let's walk through these points. When you look at the gold market, what you see is that it hit an all-time high, and importantly, you say it stayed above there.
Yeah, that's right. So since 2020, there's been 4 different times that we have, neared these all-time highs, but not broken above. really big deal here on March 8th. We broke above. And so as we've broken above those levels, that means that there's more room to the upside.
Got it. Second point here, Dave, when you look at the gold market, what you're pointing out is you think what was a ceiling is now actually a new foundation.
That's right. When we break above 2100 and then stay above, especially as a week close, that has now become our new foundation or floor. And so I don't think that we're going to be going below 2100 from this point forward. It's just up from here.
Got it. And finally, talk about the role of central bankers.
Okay, so ultimately, the reason why the prices has been going up is not because advisors have been allocating inside of 60-40 portfolios into gold. There's not even 1% allocated there. The reason why it's been going up is because of central bankers like China that have been buying thousands of tons of gold on an annualized basis. Now, China doesn't do anything in secret. They're ultimately trying to let everyone know here that this is something that they think is very important, and they're buying thousands of tons of it.
Now, so those are three reasons before everybody piles in. David,
that's right.
What would be, viewers are thinking about making a move into this metal, what would be the risks that you would point out?
Well, because the U.S. dollar prices gold, the dollar is ultimately, if it gets stronger, that means that the value of gold goes down. But what we're seeing right now is inflation still continuing to rise, and so the opposite is actually the case. Gold has gone up while the U.S. dollar has actually lost some of its purchasing power.
All right, so let's turn to what you don't like here, David. So
sure.
let's talk bonds, specifically the AGG. Let's go through those reasons as well. Your first point here is, frankly, our expectations of when the Fed's going to cut and by how much they've been shifting.
Yeah, if you just even look at the price movement this year alone, we started out the year with 6 Fed cuts priced in. Now we're looking at maybe a couple. I think that might even go down to 0 if inflation continues to peak up. And so ultimately, if you own bonds, there's a seesaw effect. If interest rates rise, the value of bonds go down. This is a part of the reason why so much has been lost in bond portfolios, AGG specifically, over the last 3 years. We're actually negative, still 316 this morning.
You're in good company, by the way. You see some noted economists, by the way, also telling their clients we think there's increasing chances of no cuts.
That's
Your
right.
second point here, let's just talk about yield.
Yeah, so, if the yield on the AGG is 3.3%, that's one of the reasons why you would own it, is that you could get paid. Now, the challenge is today that they have to compete with U.S. Treasuries that are not only safer, but even on the shorter duration, so less of that swing risk there with the interest rate movement, you can actually get a better rate of return. And so I think that a lot of the corporate bonds right now just don't even look nearly as attractive as the safest place, yielding higher, shorter duration.
Final reason you would steer clear, you just talk about, frankly, refinancing costs.
Yeah, that's right. So ultimately, we're looking at a world right now where corporate debt is having to remetabolize this debt at double the cost of what it was, here in 2019, 2021, when every good CFO, got as much debt as possible. And now they're at this point after 5-year terms that they're going to have to refinance this. And so everyone wants lower rates, greater liquidity in the banks. The challenge today is that rates are twice as high, and there's not as much liquidity right now in banks. So I for sure see Chapter 11 is going to be coming strategic defaults. And of course, the downside with that is that if bonds have defaults, you actually get 0 back. You lose it all. So is that really the anchor that everyone wants to be focusing on right now when we're at these all-time record highs in U.S. markets?
And let me ask you, it's going to be the same question, David.
Sure.
What is the kind of risk to your call, the upside risk here?
Yeah, so the upside of risks is that, if rates trend down, the Fed was forecasting 6% or whatever on the year, at least the duration on that AGG portfolio is about 8.5 years. So you actually would make money if rates dropped. It's just that the sentiment right now and where we are today, with unemployment where it's at, CPI rising, all these things, it is not very likely that the Fed is going to be able to reduce rates in a meaningful way unless something significantly breaks, which would actually be pointing to AGG, and then I literally wouldn't want it anyway. So.
All right, David, let's sum this one up for investors because there's a lot to go over there. So you're telling investors, listen, buy gold and silver as they are one of the few asset classes offering both exceptional value and promising growth prospects. On the other side, though, you're saying avoid the U.S. aggregate bond ETF that's amid a lower outlook on a Fed pivot, the option of yield from treasuries, and the risk of holding corporate debt. Thank you so much for watching Goodbye or Goodbye. We're bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
With less than 30 minutes left to go in the trading day, shares of Boeing holding on to gains, but off the best levels of the day. The troubled jet maker announcing CEO Dave Calhoun will step down at the end of the year. Search is now underway for a replacement. Let's bring in Ronald Epstein, Bank of America Securities Senior Aerospace and Defense Analyst. Ron, let's sort of move the conversation forward here. What are some names you're thinking about in terms of who needs to take the helm at this company, given where it is right now?
Well, they've said they're going to have a broad search, right? So the new chairman of the board is going to execute a search, most probably internally and externally. The candidate or candidates, they're going to need to have some specific skills. They're going to have to generate goodwill from internally from employees. They're going to have to repair relationships with regulators, namely the FAA. They're going to have to repair relationships with the airlines, and they're going to have to repair relationships with the flying public. And they're also going to have to be an operating executor. So it's a big bill to fill. I'm certain there's some internal talent, but I'm certain they'll also look externally.
Do you think, Ron, listen, they're making some big changes in the C-suite here, but do you think there's kind of broader cultural changes that need to happen at Boeing as well?
Yeah, this is part of it, right? I mean, we've been writing for some time that Boeing's going to require a broader cultural change to improve execution, to put aircraft fabrication over, the time it takes to build airplanes, make that secondary to safety. I mean, that's been the issue, to flip that around, to make safety more important than the time it takes to build an airplane. And probably the most important thing that Boeing's going to have to do is think about what that next airplane is going to be. Dave Calhoun said earlier today in an interview that this next CEO is going to oversee the development of a new airplane that could cost upwards of $50 billion. We've been saying for some time that Boeing has to do a new airplane. And so this new CEO is not only going to have to fit the bill that I said before, but also have the engineering prowess and the strategy to understand how to develop a new product that could be in the markets for upwards of another 50 years, like the 737 before it.
Ron, that list you just ticked off about what needs to change at the company is a long one. This is not an overnight transition that we're looking at. With that said, is it time for investors to reset expectations for the company?
Well, I mean, the company, interestingly enough, we hosted a conference last week in London. It's the Bank of America Global Industrials Conference. And Boeing CFO Brian West spoke at that conference. And at that conference, he reset financial expectations. And at the conference, he mentioned that the company in the first quarter would burn through somewhere between $4 to $5 billion, have negative 20% earnings margins, EBIT margins in the commercial airplane business, and that the company would maybe get to $1 to $2 billion of cash flow for the year in aggregate, and the aircraft production would exit the year at maybe at about 38 airplanes. That was a reset there. Investors need to think about financial targets and medium and longer term targets with a change in leadership regime. They tend to change targets too. I don't think anybody would argue with the fact that it was time for a change. Change is happening. It brings uncertainty. We'll see who the next leadership regime is, and they'll bring their view and their outlook and everything with them.
Ron, right now your rating is a neutral, so you're on the sidelines with this name. What do you need to see, Ron, before getting more bullish on Boeing?
Well, when you think about Boeing, there's really a tug of war between a very, very strong commercial aerospace market. If you look at demand for airplanes today, it's exceedingly strong. People are flying, air traffic's growing. However, that's offset by the uncertainty in production that Boeing's been confronted with, and particularly on the 737, a little bit on the 787. They're still having to certify a couple of the 737 models, and the 777X is still in development. So, there's a tug of war between the two. So good end market, lagging execution. I mean, obviously, if one can get a feel for better execution, maybe that could make one feel better about the stock. But right now, I don't think anything's going to change overnight, and we're very comfortable with our neutral rating, and we think the stock will be range bound.
Ron, thanks so much for joining the show today. Appreciate it.
Yep, thank you.
Time now for more of the day's trending tickers. We near the close of the trading day, taking a look at shares of Digital World Acquisition. That stock surging as the company completes its merger deal with Trump Media and Technology. So former President Donald Trump's media company, Kiko, ready to make its public debut tomorrow. Expected to trade on the Nasdaq under the symbol DJT.
DJT.
I think you can all guess what that stands for. Could mean a windfall for Trump, by the way. Literally billions worth of shares potentially here, though yes, they would be subject to a lockup, of course, but coming at the right time for Trump, just given his many legal challenges at the moment.
Yeah, I mean, on a day where he was able to reduce that bond payments for his fraud trial to $175 million, you got to wonder, investors are watching this saying, well, this is a pretty good time, right? But to your point, $300 million locked up. Mm-hmm. Got to find a way out.
Yeah, now could he pressure the board to kind of expedite that schedule? You know, you look at the financials, too interesting, Akiko. Trump Media lost about $49 million in the 9 months through September, generated only about $3 million in revenue. So it'll be interesting kind of what is this company's strategy exactly, right?
Do we know what the user numbers are?
I don't know. I have not seen that. That's a good question.
I'm curious to see if he gets a bump there in an election year, right? Increasingly polarized.
We'll see what the reception is like.
Yeah, we do like to. Going to be talking a lot about Trump between now and November. Taking a look at the crypto space, Bitcoin prices jumping above 70,000 as the crypto steers back into rally mode. The move higher also lifting Bitcoin-linked stocks, MicroStrategy and Coinbase as well. Not necessarily news tied to this move that we're seeing today, but you see MicroStrategy and Coinbase getting a very healthy bump on the back of this.
Well, remember last week the story was we were talking so much about was money getting yanked out of those new shiny spot Bitcoin ETFs, which of course have been a big reason Bitcoin has rallied the way it has. And today it looks like investors are kind of willing to look past that, kind of give that a shrug. And of course, kind of looking ahead, we do have the so-called Bitcoin halving coming in April. We've had bulls on the show saying, hey, maybe that could be another catalyst.
Yeah, some pretty bold calls out there coming on the back of that as well. But you know what's been interesting, Josh, is that so many people we've been talking to about Bitcoin say this rally is a much healthier one because there was that shakedown that came down after the big rally that we saw back in November of 2021. So we'll see if this continues to hold, but we're looking at, can we see that again? Was that 70,000?
It had gone over 70,000. Yeah, for sure. Over 70,000. I think that was the first time. Yeah, it was in more than a week.
Expect those calls for 100,000 to get louder.
That's it. All right, finally, Take-Two Interactive's highly anticipated game, Grand Theft Auto 6. Akiko, I know you've been waiting, reportedly facing a possible delay for its launch. So this one's interesting. Take-Two kind of, taking a tumble there. It's down about 5% in today's trade. It does look, Akiko, like it was due to this headline from Kotaku reporting that production of Grand Theft Auto 6, which of course has the blockbuster, has a lot of fans and investors excited, that had started, again, reportedly to fall behind, could miss its 2025 release window. They were citing sources for this report who were apparently saying that Rockstar Games, which is the unit behind the game, still looking for the game to release in the spring of 2025, but could be the fall instead, or maybe even 2026, again, according to this report. So that explains, I think, the downtick.
A lot of coulds in there, but I mean, it does point to just what a blockbuster franchise this is, right? Are you a gamer?
I'm not a gamer. I'm not anti-gaming, but I am not myself a gamer, no.
I can't remember the last time I played Grand Theft Auto.
No. So two non-gamers talking.
We'll get Dan Howley back on the set.
Yes.
Dan Howley, for sure,
yes.
has been watching this one closely. As the first quarter comes to a close, what should investors expect from markets over the next few months? We'll discuss in our investor playbook on the other side. Well, the final trading week of March and the quarter is underway. What is Wall Street expecting from the markets in the upcoming second quarter? We are looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now is Ross Mayfield, investment strategy analyst at Barrett, alongside Dea Pernas, Pernas Research co-founder. Dea, let's start with you first. What do you have your eye on as you look ahead to the second quarter?
I think that one of the items that we're looking at for the second quarter are rates starting to come down a little bit. I know we went from an expectation of about 7 to 3. That being said, for companies that have a large amount of debt, for companies that have variable rate debt especially, and you find a lot of that in small cap space, I think that could be interesting. You have to be very selective. There are sectors we continue to like renewables and AI. And I'm cautiously optimistic on the valuation of the broader market right now. We do think we're probably due for a breather, but there's still many reasons for optimism.
Ross, let's bring you and get your kind of big picture viewpoint first here, Ross. So we've been in rally mode. Do you think that continues in Q2?
Yeah, I think the idea of a breather is probably right. You know, some orderly consolidation is probably in order. We've had a really historic, kind of momentous 5 months here. But everything that we saw over the last 4 or 5 months is bullish over the intermediate term. So continue to be bullish. Everything we've seen from a breadth perspective, from a momentum perspective. But again, a breather probably in order here at, extended valuations. We've seen the stats on how low volatility has been. Haven't had a 2% pullback in, some historic number of days. So a breather, but bullish, intermediate, and longer term.
Dea, let's talk about some sectors that you're watching closely with that expectation of rates coming down. Certainly, when you look at something like wind and solar, renewables have been hit hard by the higher rates because of the high capital costs that come through. What do you like there? What's your expectation as you think about the rates coming down?
So when it comes to renewables and when it comes to growth sectors in general, all we're really looking for are growth trends that we can have a high degree of conviction in. So what matters for us is if we can say with confidence over the next 3 to 5 years, if those penetration rates are still moving in the direction that we hope. And with renewables, as you alluded to, a lot of those services and a lot of those products are debt financed. So if you get an increase in rates, you're going to see a reduction in demand. And a lot of that has been sold off. Some of it has caught a bid in the last couple of weeks, as you saw after the FOMC meeting. You saw a more dovish Jerome Powell. But that being said, I think you need to look more towards the long term. And really, we're still at the first and second inning of a lot of these renewable trends. If you look at solar and wind is going to make up around 40 to 50% of our energy source. As with respect to today, it's only at about 10%. So when you look at those trends in that perspective, I think you can gain a lot of confidence in those types of companies.
Ross, I'm interested, just going back to you. You sound constructive on the market, Ross. I'm just curious, your list of worries, Ross, what would those be? Would it be, valuation, a lot of talk about sentiment? Is it seasonality, some combination there?
Yeah, I mean, valuation, not historically a great timing tool, especially if we're talking, over the next 3 to 6 months, Q2. So valuation, not a big near-term worry, especially, as was mentioned with some of the growth trends. I think there's an ability to grow into the valuation of the market. Probably the biggest short-term headwind is sentiment, where investors are quite bullish. You can look at the surveys or options positioning. There's just not a lot of fear out there, which is usually a sign that you could be due for a pullback. But again, the overall macro backdrop is so constructive that I think any consolidation or pullback would be something that would be considered viable. I mean, there are places of the market we like better than others, but overall, rates starting to head down. The macroeconomic backdrop still pretty good. Earnings starting to inflect higher, revisions higher. So all in all, a pretty good backdrop. I think sentiment would be the one thing to watch near term, but again, that's more of a tactical thing and not something that would worry me over the next, say, 12 to 24 months.
Ross, a question that we've been asking a lot of our guests, where does political risk come into play in all this? I know we're talking about Q2, the election's not until Q3, but how are you thinking about that piece right now as we see that conversation around the presidential election be amplified more?
Yeah, I mean, for us, and especially in our business, the biggest risk is that people will allow the heated sentiment and rhetoric of the presidential election to goad them into a move that's counterproductive or not good for their portfolio long term. The stats are out there. The market is apolitical over longer time frames. There are policy items to watch, in particular, what happens to those tax cuts that expire in 2025. But the big mistake or the big risk for most people is that they let the rhetoric of the political cycle impact their decision making in their portfolio. Again, the economic backdrop is strong. The economic backdrop and earnings backdrop is what matters for markets. If you want to watch Washington, watch the Fed and watch interest rates, because that, I think, matters a lot more than the presidential election.
Daya, same question to you. How are you thinking about the upcoming election?
Look, I think I agree with a lot of what Ross said. I think that there's going to be a lot of noise, but if you try to make any sort of knee-jerk reactions based on if we're going to get a blue candidate elected, if we're going to get a red candidate elected, I think you're harming yourself with those types of decisions. Really, if you look at the historical patterns, it ends up being a lot of noise. And as investors position themselves for the future, they should look a little further out and really just have balanced exposures.
Daya, when you think about where investors should be positioned right now, what's the one sector you think that's being overlooked?
I think clearly AI has seen a significant amount of hype this year. I think that hype is very rational if you look at the consequences from a lot of this AI spend and what exactly the boon to productivity that will result in the next 5 to 10 to 15 years. I mean, when you put it in perspective, AI could be even more consequential than the internet. And I'm not saying that that's going to happen, but it's at least something investors should consider. And one of the big risks that investors face is not having enough or any exposure to some of those long-term trends where they kind of view it as hype and, oh, it's maybe a bubble and it's likely to maybe go away in a couple of years. So as long as you have some exposure there, I think that you're going to be totally fine and your portfolio is going to look pretty good over the next intermediate to long term.
Daya, Ross, thank you guys both for joining the show today. Appreciate it.
Thank you.
Thanks.
Heading into the close, we're watching shares of Reddit. They are rallying nearly 30% here in their third day of trading. IXIC, of course, they made their public debut late last week. We saw a huge pop initially, then kind of sunk into the red. Now jumping again today's trade. Such an interesting company to think about because obviously big user base, very committed, healthy top line growth. On the other hand, I think maybe it did catch some people by surprise that a company that's been around so long was still posting net losses, like $90 million in 2023. But you can see investors piling in today.
Yeah, to me that says that there's still a lot of enthusiasm for social media, right? I mean, that was part of it, is that we haven't seen a social media IPO in a very long time, Reddit providing that. I am curious what this means ultimately for the IPO market largely. We were talking last year about the likes of Instacart and some other ones coming to the market, whether that's going to unlock this avalanche, so to speak, of IPOs. Haven't necessarily seen that. This could be another sort of catalyst to maybe have some companies who've been on the sidelines say, maybe it's not now is the time to get in because the appetite is there.
The stock market doing what it's doing, hitting record, and now you see the kind of receptions that Reddit is getting. You do wonder whether it's going to unlock some enthusiasm for sure.
Yeah, we'll be watching that one closely. Well, while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all of the action following the closing bell. Stay tuned for Market Domination Overtime.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
That's the closing bell on Wall Street, and now it's market domination overtime. Akiko and I are joined by Jared Blickery to get you up to speed on the action from today's trade. So let's see where the major averages ended today. You can see the start of this kind of shortened trading week here. Traders taking some bit of a breather, taking some chips off the table. You can see the Dow down about 0.4%. The Nasdaq down about 0.3%. The S&P 500 also down about 0.3%. You kind of wonder whether maybe some caution could be creeping in a little bit here as well. You got some big data on deck. PCE, that's not going to be happening. We're going to get that on Friday. That, of course, is the Fed's preferred inflation gauge. Jay Powell also scheduled to speak on Friday as well. Jared, over to you for a closer look at today's sector action.
Well, thank you. I'll get to the sectors in a second. First, I want to go to the Wi-Fi Interactive, where I am tracking the share price of Reddit. This is only its third day of trading. It is up 30% today, so that is quite the impressive run. Also, I should note that this is the first day of options trading in that issue. And you can see from the intraday price last Thursday, it's up about 30%, so pretty impressive there. Also, Astera Labs, this came to market last week. This is up 37%. Let's see the total for today. That's up 21% for Monday alone. So two, not necessarily AI stocks, but AI tangentially related stocks recently come to market, and the IPO market has been very thin, and we're just waiting for it to kind of come back here. But here's the sector action. As promised, we got energy in the forefront. That's up almost 1% today, followed by utilities and materials. Materials just barely in the green there, and tech was the biggest loser. XLK down 68 basis points. Also very similarly down is about industrials, and then you also get into real estate. But I just got to end here real quickly on the price of Bitcoin, because Bitcoin up over 70,000 for the first time in about 10 days, Akiko.
Wow. $70,000, what we're looking at there. Well, I'm watching shares of Intel and AMD ending the day lower after a Financial Times report that China would be blocking the use of the company's chips in government computers. This points to a further decoupling we've been seeing between the U.S. and China when it comes to the critical tech infrastructure. The FT reporting that these guidelines actually came through in December of last year, ordering government agencies and political parties to require safe and reliable processors and operating systems. Bottom line, they're going with China-only parts here, and that could really hurt a company like Intel. Gets 27% of their revenue from China. AMD, it's about 15% there. There's also questions about just how much of this revenue is derived from these government accounts. But certainly, this is only going to accelerate that timeline that we've been seeing for China as they look to build out their chip technology and supply.
Yeah, Bernstein's Stacey Rasgon, you see that at Kiko, he covers both names. He kind of crunched the numbers. Bottom line, he estimates, and he did emphasize very roughly, he thought that a total cessation of China government purchases of Intel and AMD CPUs might impact by low single digits, but a bigger earnings impact on Intel. That's what he was figuring. Made no changes, by the way, to his rating. It's still market perform on both names.
Well, by the way, FT reporting that state-backed companies were also told to transition completely to basically a China-made computer. 2027 is the timeline they're looking at. That's not that far off when you think about China, where they are, having to build out everything because of the export controls in place from the U.S. They don't have U.S. equipment. They don't have U.S. designs, U.S. advanced chips. So we're going to be watching that story, obviously, very closely, something that we've been watching, especially that's been weighing on Intel shares. Well, stocks losing steam heading into the close, declines across the board. Josh Schaefer is here with the takeaways. More upside to the S&P.
More upside to the S&P, Kiko, is one of the broader takeaways I had from today's market action, and that's based on some equity strategy that came out today. John Stoltzfus over at Oppenheimer upgrading his call for the S&P 500 to end this year at 4,500. 5,500, not 4,500. We're not going down that far. 5,500. He had previously called for 5,200. And interesting because he was one of the most bullish strategists on the street coming into this year at 5,200. And everyone sort of wondered, he says now, he felt like a lot of the investors, their clients said, is that too optimistic? Is 5,200, a little too bullish here, John? Well, we hit it less than 3 months into the year, and we really hit most of Wall Street's targets. And what was interesting in his note, and he told us this earlier when he came on air with us, he said he thinks the risks are largely to the upside here. And the fact that he wrote directly in the note, we acknowledge the possibility that we might need to raise the price target again later this year should our economic and market outlook prove too conservative. And I think this is just a little bit of a trend we're seeing, guys, in largely every economic metric over the last year. It feels like consensus has continued to come up with it, right? We've seen projections continue to come up. You could say a similar story for earnings too. Earnings projections, while they often fall as we get closer, largely the story has been one of an upward trend. And it seems like across the street right now, people are sort of wondering, okay, are we just going to keep going to the upside? Where's sort of the downside risk and sort of weighing those?
Is it all about the Fed ultimately? I mean, is that the clarity coming through from the Fed that's going to push things further to the upside?
So it seems like the clarity from the Fed is part of the broadening argument, right? So those that are in the broadening camp feel like they might need more clarity from the Fed for some of those interest rate sensitive sectors to sort of join this rally more. But Stoltzfus largely argues, well, earnings have held up to this point with restrictive rates. At some point, why should I keep wondering if they're not going to hold up? Like the take that rates are going to eventually compress companies, hurt margins, and hurt earnings hasn't really played out overall. So at some point, why should we just keep waiting for that? And I think that's sort of, the argument makes sense. Of course, there are always those risks to the downside, but it's been interesting to see some of these areas that these strategists are watching pick up today, like we saw with energy. That's my other takeaway today, Josh. I led you. I had to take a break. Energy.
Well, energy, yes.
Energy. We're going to bring in, we're going to talk about energy led today overall. It led the sectors. And we've been seeing that trend for a while now, guys. And I just wanted to highlight this because it's interesting when you look over the last month how much energy has outperformed. Energy's up 8.5% over the past month. The next closest sector is materials. That's up about 5%. And nothing else is up more than 3%. What's interesting about this is energy's rally. It's one of the only 4 sectors outperforming the S&P 500 this year. It's basically all in the last month. It's been totally ripping over the last month. Part of this has come as we've seen commodity prices rise, But I brought a chart from Mike Wilson over at Morgan Stanley who upgraded energy to overweight today. And what's interesting, he points out, look at the divergence you're seeing in energy's relative performance, the sector, versus Brent crude oil. Normally they would kind of trade together and you would see energy start to pick up and trade closer to Brent crude. And that just hasn't been something we've seen. So that's sort of why they think there's maybe more room to run in that trade.
Yeah, you also wonder how much valuations have fallen, right? When you think about where it's been last year, is this that trade?
Right, yeah, and will it pick back up, right? Because it's one of the sectors that has significantly lagged when you zoom out to like a 6-month picture. Energy's up 3% and the leading sectors are up over 20%. So it hasn't really played into the rally this far. But one other thing we got to highlight that did play into the rally. Bitcoin over 70,000 again.
First time since last week, I think.
Yeah.
Jared Blickery did tell me, though, it is Bitcoin's best 24-hour performance tracked on Yahoo Finance in the last year. So it's its best day. It's hard to track Bitcoin as a day, right, because it never stops trading. But we're seeing the best 24-hour action on the crypto in the last year. Guys, the thing that stands out to me here is just we saw Bitcoin come down. We follow these prices every day, right? And we saw it come down a little bit in the crypto trade, come down a little bit last week. And I sort of thought, okay, maybe we're stepping out of the Bitcoin moment for a second again now, and we're not going to talk about it every day. And then MicroStrategy goes up over 10% today, and Bitcoin's up also almost 10, and it's like, it's just not going away.
Yeah, the story last week, I remember, Josh, we were talking about was just money getting yanked out of the new spot Bitcoin ETFs. That was the narrative. It looks like today, at least, investors just want to shrug that one off.
Yeah, it seems like the interest itself from investors isn't going anywhere, right? You wonder at what point does the price get bid up and sort of just... Crypto goes through these moments where people get excited about it and then sort of it just falls by the wayside and we stop talking about it for a month.
Suddenly the 100,000 call by the end of the year doesn't seem so off.
No,
we were talking about this like end of last year, you thought 100,000.
Right.
Here we are at the end of March.
And it's one of those things that, as David Hollerith and I highlighted in the story we did on crypto price targets, I mean, it's just a price-driven, it's just demand, right? And so if demand keeps coming back to the market here, then the price goes up. There's no real fundamental story to be told about Bitcoin largely. So if we keep seeing investor demand, then perhaps the price keeps ticking higher and we keep talking about it.
All right, and now the halving in April. Halving.
Oh, I'm excited for that. Josh, the halving. I mean, we're going to have a whole day on that.
When you say halving, do you feel like a Lord of the Rings character?
Halving.
I got to look into this halving more so we can talk about it.
We're going to have you back on to talk about the halving.
Yes, next half.
Thank you, Joshua. Appreciate it. The Fed sending out mixed messages when it comes to rate cuts. 3 officials speaking out today, including Chicago's Fed's Austin Goolsbee, who spoke exclusively with Yahoo Finance's very own Jennifer Schonberger. And Jennifer joins us now. Jen.
Thanks, Josh. That's right. Chicago Fed President Austin Goolsbee telling me in an exclusive interview this morning that he expects 3 rate cuts this year and echoed Fed Chair Powell's sentiments in saying that he doesn't believe the overall picture for inflation has changed that much, despite hotter readings on inflation in the first couple months of this year.
It seems hard for me to view that the 7 months previous to the start of this year were just random. So we're in an uncertain state, but it doesn't feel to me like we've changed fundamentally the story that we're getting back to target.
Markets are still betting that the Fed will initiate its first rate cut in June, but Goolsbee wouldn't commit to that timetable. When I asked him whether a rate cut in June is still on the table, he told me, quote, "Everything is always on the table or off the table." Elsewhere in other Fed speak today, Atlanta Fed President Raphael Bostic reiterated that he sees 1 rate cut this year and says that he sees that cut coming later in the year than previously thought, underscoring that the Fed can afford to be patient so long as the economy holds up. And Fed Governor Lisa Cook, speaking at Harvard University this morning, said that the Fed is not in a rush to lower rates, saying, quote, "Fully restoring price stability may take a cautious approach to easing monetary policy over time." Guys?
Jen Schonberger, excellent interview there. Thanks so much.
Thank you.
Well, coming up after a round of downgrades from Mizuho, we're taking a closer look at the electric vehicle space. That is next on Market Domination Over Time.
Electric vehicle makers looking for footing amid a challenging EV market. Tesla, Rivian, and NIO losing their bullish rating from Mizuho, while Fiscal faces the termination of discussions with an automaker for a potential transaction. Now, here to dig into the state of the EV space, let's get to Autoblog editor-in-chief Greg Migliore. Greg, it is always good to have you on the show. And I don't know, Greg, you know, we start off the show as talking to Kiko about the team over at Mizuho, and they kind of took their red pen out, Greg, and they really slashed their ratings and a bunch of EV makers, and bottom line, they looked, at least near term, Greg, they were getting kind of concerned about what they were seeing. When you look at this slowdown we're seeing in EV sales, Greg, what are your explanations for it? You know, is it price? Is it rates? Is it just the build out of the infrastructure network? Is it all three, Greg?
Hey guys, thanks for having me. And yes, I think that's a good way to put it, is it is all three and a few other things you want to throw in there. I think you could throw politics. I think you could throw just some, almost like most of the early adopters who've already had the EVs, they already have them. So they're not looking out to go and get another new EV. I think price is definitely something that's a consideration for consumers. EVs are generally more expensive, even with some tax incentives and some ambitious price cuts that we've seen. There's some pretty good deals out there on things like Ford Mustang Mach-E and other vehicles that are, you know, very compelling to drive. But I think the situation has been pretty uncertain for consumers. Right now, you're seeing maybe a little more consistency with things like hybrids, plug-in hybrids. Hybrids have about 8% of the market, which is the same amount as a true EV has. So I think you're seeing just, you know, consumers are kind of hedging their bets right now. And frankly, a lot of people are staying with the existing vehicle they have for a while as they try to let the market sort everything out.
Greg, I was just saying, I feel like we have weekly conversations about where the EV market is going to go from here. But, you know, it feels like the bet in this next phase is going to be about the lower cost cars. As you look across the space, whether it's GM on the legacy side, whether it is a Rivian, a Tesla, who do you think is best positioned to offer up that cheaper car with other competitors like Chinese players coming into the market? Not necessarily the U.S., but in other markets.
Sure. I think there's a number of competitors out there. I think right now what we've seen is a lot of strong entries from legacy automakers like BMW, Mercedes, Cadillac at the high end of the market. And that's easier to do because you can basically pay for the battery tech and the design and all the things you need to do to make a compelling automobile with a higher price tag. It is much tougher to come in at a lower price point. I think Chevy has a number of compelling vehicles like the Blazer, like the Equinox, the Bolt is coming back. Honda's doing some interesting things. Volkswagen is trying very hard from a variety of price points, bringing back brands like Scout, which is essentially like a Jeep fighter, only it's all electric. Some of their vehicles are going to be relatively competitively priced. So there's a number of ones out there. I think when you look at, say, the China market, that's where you see companies like BYD, which are really investing in lower cost vehicles to compete in their own domestic market. I think that company specifically, as well as China, sees this as an emblem of a way they could grow their economy, much in the same way General Motors did in the United States 100 years ago.
Greg, I'm curious where the Korean car makers, where you think they're positioned in all this. When you think about what's already on the market, not necessarily what's about to come to market, I mean, it feels like they have the most value. I mean, I'm just thinking about just what the kind of cars I see on the road out in California. It feels like if you're looking for a fair price point that's not, you know, more than 40, 50, that's kind of a good spot where the Korean car makers are competing in right now.
That's a great point. I think Hyundai and Kia both have several competitive, attractive EVs on the market that you could get right now. The Kia EV6, it's fun to drive. It has great range. It's won a lot of Car of the Year awards. Then you look over at Hyundai, and they have the IONIQ 5, which is a hatchback, kind of like 1980s, almost like Tron sort of styling. And then the Hyundai IONIQ 6, which is this swoopy, almost like Art Deco coupe-styled four-door, which, you know, they have the same powertrain, so they both have great range. They're fun to drive. So I think the Korean car makers are very well positioned at a little bit more moderate price points. Their new brand of like Hyundai Motor Co. is Genesis. They've been around about 10 years. They're getting into the EV space with things like the GX60, things like that, the GV50, excuse me, and just trying to make a more well-rounded portfolio.
And Greg, I'm also interested to get your take on Rivian, because that was another one of those names the team at Mizuho downgraded today. You know, you hear folks say, Greg, you know, Rivian, strong brand, but then they'll also point out, you know, just the R1, you know, model pricing is just kind of tough in this environment. What are your thoughts on that one?
So I think Rivian is well positioned for growth in, a few years down the road. I think what's tricky for them is they have started out with the R1S and the R1T. So that's the SUV and the truck, which are pretty expensive. They're definitely luxury items. They bring that lifestyle sort of approach to, you know, well-heeled consumers who want to have, you know, a discussion piece when they pull up wherever they might be going. Now, a couple weeks ago, they showed the R2 and the R3, which are lower priced vehicles, very attractive, compelling range. We think they're going to come in, again, at a much lower, more attainable price rate. You can order one. They're $100. I think it's a refundable deposit. But like with Lucid, like with Fisker, a variety of startups, there's always a degree of uncertainty with Rivian. I think among the startups, they're probably one of the better ones that's positioned, though, from what we're seeing.
Greg Migliori, as always, good to get your insights. Thanks so much for joining us today.
Thank you.
Time now for To Watch Tuesday, March 26th. Trump Media and Technology Group starting to trade tomorrow. The parent company of former President Donald Trump's Truth Social trading on the Nasdaq and effectively adding billions to Trump's net worth. This coming after a New York appeals court today gave Trump 10 more days to post a $175 million bond to satisfy his New York civil fraud case.
And turning to the economy, the Case-Shiller Home Price Index for January coming out in the morning. Economists forecasting the prices to go up year over year and hold relatively steady from the previous month. This comes after home prices hit a new all-time high in December. The report giving us more insight into the value of single-family homes as mortgage rates still hover around 7%.
And finally, on the earnings front, McCormick & Company and GameStop both reporting tomorrow. GameStop announcing fourth quarter and full fiscal year 2023 results after the closing bell. Gaming retailer having a rough start to the year, down more than 10%, but closing higher today.
And tomorrow I'll be watching the Case-Shiller Home Price Index report. Specifically, this is the one that, of course, tracks the 20 largest cities. And it's going to be interesting to me because so much of the focus has been on rates. Expectation here is that the prices went up 6.6% year on year. At the end of the day, it is about the inventory, right? I mean, it hasn't shifted because of where the inventory is.
Right. I mean, if you were locked in at 3 or 4%, are you moving? I mean, tough.
Well, that's a good point.
Yeah.
You've got sort of two tracks here. The buyers may be getting back in as they see rates come down. If you're looking to sell, yeah, you still are locked in. By the way, did you get a house, Josh?
No.
Okay.
Looking, if there is a realtor listing right now, I'm all ears. DMs are open, Akiko. All right, you're looking at housing. I'm gonna go. You know what? I'm gonna go with GameStop on my radar tomorrow. They report expectations. Let's call them muted. Akiko, how's that? This stock is deep in the red this year and over the last 12 months. It's pretty ugly. Question is, will a solid quarter for the industry, Akiko, help GameStop with this print? That's what analysts are asking. Michael Pachter, though, over at Wedbush, friend of the show, he told his clients, yes, maybe you see some upside tomorrow when they report, but still sees plenty of obstacles, including, of course, that just broad secular mix shift of game sales from physical to digital. Says the lack of a clear strategy, Pachter says, to enter new categories of compelling growth potential. Also a problem. He's sticking with his underperform, so a sell target is $6.
Yeah, it feels like that has been the ongoing theme, right?
Mm-hmm. Yep.
No real strategy in place for GameStop.
Maybe tomorrow. Tune in. We'll see.
Okay. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Stay tuned for more Yahoo Finance on the other side. Trump Media and Technology Group, the parent company of Truth Social, will begin trading tomorrow on the Nasdaq, but the social media company facing plenty of skepticism, including from our very own Rick Newman. Rick, skeptical? I'm shocked.
Well, this company's having a nice ride for the moment. I mean, it's up by quite a lot so far this year, and that's obviously based on the expectation of it going public. And people are trading. I think, a lot of the individual buyers of the stock are people who want to support Donald Trump. And if he actually wins the presidency in 2024, then the operational outlook for this company might be fairly good. But there's a lot that can go wrong here. And I looked at the short interest, in other words, the people betting that the stock price is likely to fall rather than rise. So based on data from S3 Partners, which tracks this kind of thing, short interest in this company, which is going to be known as Trump Media and Technology Group when it goes public, is about 11%. That's not super high. The average for most companies is about 3 to 4%. But short interest is severely constrained by a lack of available shares. I mean, in order to short, you have to borrow the shares, pay for that privilege, and there just are not very, very many shares you can borrow. So if you kind of adjust for the lack of available shares to borrow to short the stock, there is very strong interest in shorting this stock, which suggests a lot of investors think that the price is going to fall. And there are a lot of reasons it could fall. First of all, the company's never been profitable. It's a niche player, to say the most, compared with other competitors like X and Facebook. Trump's personal financial situation is a factor here based on whether he might need to sell shares. And then what if Trump loses the election? At that point, his political career will probably be over. And what's the point of a social network where he's the main attraction? So, this is going to be just a very interesting way to watch. And I think this stock is a very interesting way to monetize whatever you think the outcome of the 2024 presidential election is going to be. If you think Trump is going to win, you might go long on the stock. If you think Trump is going to lose, you might go short on the stock. So very interesting play.
Very interesting. We'll keep watching. Rick Newman, thank you, buddy.
Bye, guys.
President Biden signed off on a $1.2 trillion spending package, averting a shutdown that would have affected a number of federal agencies. For more now, we're bringing in Jeanette Lowe, Strategas Securities Managing Director of Policy Research. Jeanette, it is always good to see you. So let's start there, Jeanette. So over the weekend, the Senate does pass the $1.2 trillion spending package, ends this 10-month marathon. Jeanette, just walk us through what it means and what it means for investors who are listening right now.
Great. So first of all, thanks for having me. And so the budget actually was important to get done. As you mentioned, this was kind of a very long saga. We are now months into the current fiscal year, and we are just finally getting a budget enacted. There's a couple of important pieces to this. First of all, is that this is finally completed. This has been hanging over Congress's head for quite a while. It's taken almost a monumental effort to get it across the finish line. It does basically keep in place the deal that was negotiated with Speaker McCarthy, or then Speaker McCarthy, last year. And so one of the important things is that it does still have a 3.3% increase in defense spending over the prior fiscal year. That's important. That's something that we've been watching stock related wise. And then the other thing is that, it avoids sequestration. So one of the things that had been in this bill is that if there wasn't actually budget bills done, we would have seen a $50 billion cut through sequestration at the end of April, and that keeps that off the table.
Jeanette, when you think about where we are, we're talking about spending on the one hand today, but what can happen between now and November? Obviously, we're in a very highly polarized environment, election year. You've got some lawmakers who are saying they're retiring as well. What are some of the key issues you're watching in the expectation of what can actually be done between now and November?
Right, and it's a great point because it is an election year, and again, the budget is such a heavy lift that we've seen how difficult it has been for Congress to get things done. The House Republicans only have a 2-vote majority currently. They can only use 2 votes on a party line vote in order to keep their priorities in place. And that has meant that Speaker Johnson has had to pass most of the bills that have passed recently by suspension of the rules, which requires a 2/3 vote in Congress, which requires Democratic votes. So the things that we're watching going forward is, number one, Speaker Johnson has said that he would put Ukraine aid up on the House floor. It'll probably be different than the bill that we saw in the Senate. It could be something that's more treated like a lend-lease program that's waivable, that Ukraine actually wouldn't have to pay back. But that's something that we're watching for. That would be additional fiscal spending that Congress would be enacting during an election year. A second big thing we're watching is this bipartisan tax bill that the House actually has already passed, and now it's up to the Senate to enact. We expect there to be lobbying in their districts over the course of the 2-week recess that we are currently in. And when they come back, there is the option that they might be able to pass this bill. It's important because it retroactively would apply several business tax credits that have expired. One of the most important being the R&D tax credit to allow companies to now immediately write off those expenses for the past 3 years. And so that's something else that we'd be watching that would provide a more stimulus, provide about $136 billion this current fiscal year. And then the other things that we were watching is Congress is not going to do a whole lot more in an election year, but they have been focused on bills related to China. So we've seen the TikTok bill come up. We've seen bills banning data brokers from selling U.S. personal data. That has the most bipartisanship in Congress right now. So that is something else that we'll be watching to see if they get that done before the election or even in the lame duck period of Congress.
And Jeanette, I'm just interested to just drill down on TikTok. If you were to place a bet, Jeanette, what do you think happens there in the Senate?
So I think that they are probably going to think about maybe making some changes. It's definitely going to be slowed down in the Senate. There might also be a question as to whether or not it gets done before the election or after the election. But I do think that there are a lot of concerns with national security. You did see that they got the intelligence briefings that the House got. That led to very strong bipartisan votes in the House to pass this bill. There could be changes to how it's structured. Is there more than 6 months allowed for this divestiture to happen? But I think that it is something that they're going to be looking to do, especially because after December, we have a new Congress coming into place, and members who are currently there will actually try to get some of the things that are currently on their plate cleaned out before the new Congress comes in. So I do think it's something to definitely keep an eye on, and it is not it's not a guarantee that it's going to pass, but it's definitely something that I think has some legs.
Jeanette, really quickly, this is an app that has 170 million users. There's been some conversation about whether, in fact, lawmakers want to act on that in an election year. Is that a real threat here about the potential impact that could be shown in the election, or you think that's just overstated because young voters don't necessarily all turn out?
So I think there's two things. So yes, I think TikTok has been pushing messages on the app to get younger voters to actually contact their congressman. And so you have seen that actually been at play. And at the same time, you could see that play into the election. It could mean that young voters don't show. If there is a ban that's put into place, younger voters have been more helpful to Biden in the prior election. So that's something that could be at play. But then there's also could be that maybe more people see if they actually determine how the messaging comes out on this, if there actually is more messaging about whether or not there are these national security risks and what it means for U.S. personal data, that actually could be a strong message going into the election as well, despite the fact that it would be hurting users who are currently on the platform. So I think we still have to kind of see how it goes and what the messaging actually comes out with this bill ahead of the election.
Jeanette Lowe, good to have you on the show today and get your takes. Thanks so much for joining us today.
Thank you.
Well, coming up, we're taking a closer look at how and where consumers are shopping with JLL America's president of retail. That's coming up next on Yahoo Finance.
The New York Stock Exchange will delist shares of Fiscal, saying the company's Class A common stock is no longer suitable for listing based on its, quote, abnormally low price levels. They say, NYSE says here, Keto, that the company has a right to review this determination by committee of the board of directors of the exchange. Not really terribly surprising news, of course. Just we know this is an EV startup that's been struggling.
Yeah, this is a company that came to market through a SPAC back in 2020, and it has been a steady decline. Its stock is down more than 90% year to date. And it comes, as Fiscal says, essentially those talks with a bigger car maker that they had kind of explored about a potential tie-in. Those talks have ended, so now you have to wonder what happens to Fiscal. But, you know, I'd be curious how this all ends, because, Josh, we've been talking about this. There are still some bigger car makers out there that are not necessarily, you know, they don't necessarily have the EV footprint in place, but it does tell you, you know, was it a management issue? Was it about the broader EV slowdown? Just how challenging it is for upstarts within the EV space. I mean, forget the environment itself. It is a huge, huge task when you think about just how capital intensive it is.
Yeah, but your point is well taken. Against the backdrop we've talked so much about slowing EV sales, hard enough for like a Tesla, let alone the startups.
Yeah. Moving on here, some of America's best-known retailers are struggling to stay relevant. In the last month, Macy's announced it's closing 150 stores. Despite this, retail openings outweighed closures last year, and consumer spending is held up. Naveen Jaggi is JLL America's president of retail. Joins us here on set. It's good to talk to you today. We were talking about this morning, about when you think about where retail is headed, a lot of department stores may be looking for a smaller footprint, more localized footprint. Talk to me about what it is that you're seeing in this environment.
Well, I think what we're seeing is a big shift in the way consumers spend, right? So the days of the big department store anchored malls have a place in America, but we don't need to see as many of those big department stores because consumers have found a way to find what they want at a much closer location to their home. And it's not surprising if you think about the way Macy's is saying that their future growth is in the 30,000 square foot space. That's what they claim, that they're going to have a big effort in that level, which says to them, look, we know that there's Burlington, TJX, and those kinds of brands that are capturing a lion's share of the U.S. consumer dollar, more than ever before. That's where they can use their scale and their buying power to meet that demand. So it makes good sense for them to pivot. And as we also saw from Nordstrom's, what have they said recently? Nordstrom's Rack is the biggest brand for them to drive their growth. They've taken their focus off the department store. So department stores have a place, but I think the reality is more of these value-oriented retail spaces in the 30,000 square foot space makes the most sense because that's where consumers want to go.
Are there, Naveen, when you look across kind of the retail landscape, are there certain names that you pay, I don't know, more attention to than others, certain bellwethers that you consider for the sector?
Yeah, so if we're talking about that one particular, call it daily goods value sector, right? So if you want to talk about brands such as TJX and now Burlington. I mean, it's fascinating to watch a group like Burlington. 5 years ago, Burlington was the Burlington Coat Factory. It was not really known as a value player against a TJX or a Ross. Today, they're opening over 60 stores a year, and they're taking 50, 60, 70,000 square feet in some cases. So to me, I'm watching that entire sector and saying, where the U.S. consumer is shopping, that's the sector I want to watch, because that tells me where we spend our dollars has the most sustainability in the long run. And today, more than ever, the dollar value sector is grabbing a more lion's share of the U.S. consumer than ever before. I'm watching that sector, whether it's grocery or soft goods.
Is there something to be said also about the payoff, that the buy-in that you get at some of these discount stores in a physical store?
Absolutely.
If you think about a Nordstrom or Macy's, you don't necessarily have to go into the store. I mean, I say that as somebody who shops online a lot, but when you go into a TJX store, right, you ultimately are going there to sort of sort through things to be able to find the best value. I mean, is that a big part of
the thrill of the find? We know that a TJX, for example, will go out and find a lot of these very high demand department store type of product, but you can get it in a much smaller location. So the thrill of the seek, the search, the find, that makes it the adventure. None of those brands have a very large presence online. They have somewhat of a presence, but they actually want you to come inside. So as opposed to buying a crock pot or buying a dress online through Macy's and picking it up, which is certainly right for a big part of the American public, the adventure and finding it at a value, that's what seems to work for a lot of Americans today more than ever. And that's why I think Aldi and other brands have done the same thing. Come to the store, find a bargain you won't find anywhere else for a limited time. Get it now before it's gone.
I want to get, Naveen, just also your broad take on the U.S. consumer right now. I think they've actually surprised a lot of people with just how resilient they are. But what are you seeing now, Naveen, and what do you see kind of looking ahead?
Well, I think the U.S. consumer shocked everybody back in the holiday season, right? They were projected to do about 4.4 per year sales over 23, over 22, 5.6% over year. That tells you U.S. consumer is a lot stronger than everybody says. So to me, the U.S. consumer will remain strong as long as we have low labor. So right now, unemployment level is what, 3.7, 3.8, right? Wages are up, or at least better than they were 5, 6, 7 years ago. So to me, as long as the U.S. consumer feels strong, market is up. So their 401s feel better than they did a year ago. All of this gives them confidence to go shopping. So as long as the U.S. consumer continues to shop, and they have shown no indication to pull back on shopping, we will see a healthy retail environment.
Part of that is also execution, though, right? And when you think about it, I mean, the consumer is not all the same.
No.
When you think about where the retailers have been, those that have been able to stay ahead are those that have really executed on very specific needs that the consumers have.
So retailers, the ones who've really got it figured out, which is to give the consumer what they want and execute it really well. So we were talking about this a while ago with Lululemon. What a great brand. I mean, they've been on a run for the past 3 or 4 years. They're a hot streak, right? They execute what they have and what they make very, very well. They know exactly what the Lulu consumer wants. And so what do we see now? We see Alo Yoga, Beyond Yoga. We see other brands coming in to try and nip at their heels. But the ones who nail it really well, Dollar General and the dollar sector, they do it really, really well. There's many of these what I call brand killers that execute so well, the U.S. consumer is so loyal to them. They know whatever they do, the consumer follows.
Loyalty is certainly significant
Absolutely.
there. Naveen Jaggi, good to talk to you today. Thanks so much for joining us.
Glad to be here.
Well, coming up, the latest episode of Yahoo Finance's next series, turning our eyes to how retailers are handling theft.
Just in from Target, they announced plans to close 9 locations.
One big issue from retailers this past quarter, theft, commonly referred to as shrink.
You've seen these viral videos showing flash mob style smash and grabs. That theft is hitting profits at some of the biggest retailers, including Target, Walgreens, and Home Depot. Mentions of organized retail crime on company earnings calls went up by 43% from January through August of 2023. One of the buzzwords on those calls was shrink, an industry term to describe any hit to inventory. Shrink-related losses hit $112 billion in 2022. Organized retail crime isn't just impacting margins. Retailers say the theft is more violent now than ever. In response, they're doing what once would have been unthinkable, partnering with their direct competitors to use an AI-driven heat map that'll enable retailers to share real-time crime data with each other. all in the hopes of stopping theft before it hits any store. But if theft creeps in anyway, AI-powered surveillance will be listening in. This is what's next in retail theft prevention.
We've got what we call the engagement lab.
Can we take a look?
Absolutely.
All right, let's get in here.
It's the only place in the world like it. All of this is really, but they can see almost 400 different technologies in the same place.
That's Reed Hayes. He's the head of the University of Florida's Loss Prevention Lab, which has taken in more than 400 anti-theft technologies from dozens of companies.
Customer service is on the way to your aisle to help you immediately.
The lab evaluates how effective the tech could be in the real world.
We set up the simulation, or sim lab as we call it, to allow us to do more rapid research and learnings. We put active criminal offenders in here, we put shoppers, we put employees, and we can look at different areas, and we can do it much more rapidly, and we can do it without disrupting the actual store.
Reed and his team are funded by the university and by the Loss Prevention Research Council. That's a group of nearly 100 of the most recognizable retailers. They pay an annual membership fee of $6,500 per year to access Reed's research.
What is the next big technology that retailers have gotten really excited about when they visit the lab?
Really, artificial intelligence, AI, computer vision that can spot somebody that might be concealing goods, obviously bringing a firearm or a cutting instrument into the store. They're interested in AI that can pick up screaming, glass breaking, gunshots, but also helping us analyze activity at a more macro scale using mapping and AI.
Reed says he's using AI-powered mapping in a way it's never been used before, and in a way that encourages retailers to collaborate with their biggest competitors.
The redder that they are, the hotter they are, the more crime risk in that area.
The map uses AI to predict future crime events by pulling in data from as many sources as possible, from law enforcement to the retailers themselves. That data creates hotspots on the map, which participating retailers can see. The next step, equipping stores with two-way radios and an app that'll automatically notify managers if a crime happens at a nearby store.
Could something like this prevent theft from happening at all?
It better, it should.
The theft problem is a difficult one to quantify. One report from the National Retail Federation attributed nearly half of shrink for 2021 to organized retail crime. The NRF later retracted that claim. In congressional testimony, one economist said organized retail crime is responsible for just about 5% of total retail inventory losses.
Where do you think the disconnect is in that data?
What we do is we look at retailer data. So if we rely on public information, law enforcement information, that's very inaccurate. Not their fault. They only know what people tell them.
Retailers say it's hitting company profits. In 2022, Lowe's lost nearly $1 billion, more than 1% of their net sales. Target projected a nearly $500 million hit, all due to shrink. And retailers are paying up to try and stop it. One survey showed that more than 52% of retailers say they're spending more money on theft prevention. And for good reason. Over 60% of people called their most recent experience with locked cases, the primary tool for theft prevention, inconvenient. 20% said they'd rather order online than wait for an employee. And that's a problem for retailers that are already competing with e-commerce. That's why retailers are increasingly interested in giving the customer more autonomy through innovations like Face ID technology.
I put in my cell phone number. I would get a code to my phone, and then I would type in that code here. And now the case is open. But I have to give up my cell phone number.
That's right. But think about how much we give up online. We give our name, our address, our credit card number, all this information, phone numbers, email, just to buy online.
Could this eventually be Face ID technology?
Yeah, that way you can say, hey, here I am. I'm not in a database of stealing from here. It opens for you.
To find better solutions, retailers are coming together at events like the NRF's annual Big Show in New York City. That's one of the biggest retail conferences. There, I caught up with Reed again, this time with one of his lab members.
We went down to visit Dr. Hayes in his lab. We had an ideation meeting for a day or so, and great takeaways from that.
That's Mike Lamb, who's done asset protection for decades, working for Home Depot, Walmart, and just before retirement, Kroger.
I'm seeing more of this collaboration than perhaps ever in my 4 decades plus of being in this space, and it's so refreshing to see that.
That's why we exist as a council. 94 retail corporations now, and they want to collaborate, and are figuring out how do we collaborate better for everybody's safety.
Our primary ambition is to do just that, provide that safe environment for both customers and associates. And technology and AI in particular, I think are going to help us along that journey.
Experts in loss prevention we've spoken to say the future of safe shopping lies in AI's ability to prevent a crime before it even happens. The goal for retailers is to not impede the shopping experience. So this is the type of technology shoppers won't see, but it will be there, listening and watching.
We're looking at a whole lot of other AI plays here, picking up on what people are saying, like threatening words or victims' words, things like that we think we can also map more in real time.
Over 90% of U.S. retail respondents to one survey plan to increase their AI investments this year. But questions remain about the legality and privacy of AI-powered surveillance. At the end of 2023, the Federal Trade Commission banned Rite Aid from using AI facial recognition technology. They said Rite Aid's practices contributed to the risk of consumers experiencing discrimination. The FTC also issued a general warning to companies using biometric surveillance, indicating that they'll be cracking down on misuse of that technology, which retailers like Rite Aid implemented to curb theft. And it's not just about retailers collecting information.
I think we just, as law enforcement, need to be smart about where we're collecting information from and how, we would traditionally collect that information, whether it be through legal process or not. We always say responsible use of machine learning and data analytics and different, technologies will help us be better at our job.
That's Special Agent Mike Kroll, who oversees the Department of Homeland Security's Operation Boiling Point, an effort aimed at fighting the rise in organized retail crime, which he testified on in front of Congress.
HSI initiated Operation Boiling Point 2.0 to effectively communicate the severity of organized theft groups involved in retail crime.
To help track the severity of theft, Kroll's team created an AI-powered tool called Raven that uses machine learning to consolidate crime data across multiple jurisdictions, all in an effort to find links between individual crimes.
So I think last year we had about a 200% increase in our investigations related to organized retail crime.
Is it fair to say that the scope of retail theft reached somewhat of a boiling point where the Department of Homeland Security needed to get involved?
The threats we face are well beyond your traditional brick and mortar, stealing of toothpaste and health and beauty products. We're into sophisticated networks, many Chinese organizations who have taken to the cyber realm to conduct intrusions and other technical methodologies to steal information, to steal items, and then to turn that into a profit. People just want to make money.
How often are you getting leads from retailers?
Every day.
As retailers work to address a problem that HSI says is increasingly severe, Reed says consumers' privacy concerns will still need to be prioritized by retailers and law enforcement.
When it comes to pushback, I don't know that we've had any pushback from a current or potential crime victim, but there are people outside that are concerned. I think more and more of the retailers are saying we've got to safeguard our people in these spaces. So now they're putting things that would arguably invade someone's privacy, but nobody goes to jail based on an alert on any kind of AI technology. It's a heads up, decision maker, and then you make the call what you want to do.